Section 14. The buyer changes the deal. When one decision changes everything. We want to put less money down. Emily and Carlos's Gilbert transaction is finally starting to feel predictable again. The inspection is finished. The appraisal is moving forward. Their rate is locked. The lender is working toward final underwriting. Then Carlos calls Jason. We've been thinking about it. Instead of putting $80,000 down, we'd rather keep more cash in savings. Can we put less down? A few minutes later, Carlos calls Sarah. Good news, we're changing our down payment. Sarah immediately understands something Carlos doesn't. That may be good news for Carlos's personal financial plan, but it isn't simply a number that Sarah changes in her transaction file. Changing the financing can affect several parts of the mortgage transaction. One change can move several numbers. Think back to page 1 of the loan estimate. Loan amount, monthly principal and interest, mortgage insurance, estimated cash to close. Now imagine Carlos reduces his down payment. Could the loan amount change? Potentially. Could the monthly payment change? Potentially. Could mortgage insurance be affected? Potentially. Could cash to close change? Absolutely. This is why TRID allows for certain revised estimates when the consumer requests a change that causes an estimated charge to increase. The original loan estimate was based on one transaction. Carlos is now asking for something different. Sarah shouldn't redesign the loan. Carlos asks Sarah, what do you think? Should we put 10% down instead of 20%? Be careful. Sarah may have personal opinions about down payments. She may even own several properties herself. That doesn't make her Carlos's mortgage advisor. A different down payment could affect interest rate, mortgage insurance, loan qualification, reserves, payment, and other financial considerations. Sarah's appropriate response is, have Jason show you how the different down payment options affect your loan, monthly payment, cash to close, and any mortgage insurance requirements. Then you can decide which option works for you. That's helpful. Sarah stays involved without designing the mortgage. Now change the purchase price. Let's make the transaction more complicated. The appraisal comes in lower than the contract price. After negotiation, the seller agrees to reduce the purchase price. That's great, but the lender needs to know. The loan estimate and underwriting may have been based on the original purchase price. Escrow may also be working with earlier figures. Sarah should make sure the fully executed amendment reaches Jason and Maria promptly. A price reduction is good news only if the people preparing the transaction know it happened. Seller credits can create another ripple. Now imagine instead of reducing the price, the parties negotiate an additional seller credit. Emily says, perfect. We'll use all of it to cover our costs. Maybe. Remember what we discussed earlier. The purchase contract can establish what the seller agrees to contribute, but the buyer's loan program and lender requirements may affect how much of that credit can actually be used and what costs it may cover. This is why experienced agents coordinate with the lender before making assumptions. Sarah can negotiate the contract. Jason determines how the financing requirements apply. Maria prepares settlement figures based on the transaction information provided. Everybody has a role. What if the buyer changes loan programs? Now let's make it even more interesting. Carlos calls Sarah and says, Jason showed us another loan program. We think we're switching. That should get Sarah's attention. Not because changing loan programs is automatically bad, but because it may affect the transaction timeline. Could the lender need additional documentation? Could underwriting requirements change? Could the appraisal requirements change? Could loan costs change? Could another disclosure be required? Could the anticipated closing date be affected? Potentially. Sarah's first question should not be, why would you do that? It should be, Jason, does this change affect our ability to meet the contractual closing date? That's transaction management. The last-minute lender switch. Here's where things can become dangerous. Imagine Emily and Carlos are 10 days from closing. Carlos finds an advertisement online offering what appears to be a better mortgage. He says, we're switching lenders. They'll get it done. Maybe they will, but Sarah should immediately recognize the possible consequences. The new lender may need to process an application, provide required disclosures, obtain or review an appraisal, complete underwriting, verify assets and income, satisfy applicable TRID timing, and prepare for consummation. The purchase contract's closing date doesn't automatically move because Carlos changed lenders. This doesn't mean Sarah tells Carlos he can't change lenders. It means she helps him understand that a financing decision can have a real estate consequence. Don't make the lender the last person to know. One of the biggest transaction mistakes is making changes without involving the professionals affected by them. Sarah negotiates a price change but doesn't send it to Jason. Carlos changes his down payment but doesn't tell Sarah. Emily negotiates an insurance change without telling the lender. The lender changes a financing requirements and doesn't communicate it clearly to the buyer. Now everyone is working from a different version of the transaction. That's how mistakes happen. The contract and the loan are connected, but different. This is one of the most important concepts in this course. The purchase contract and the mortgage transaction are connected, but they are not the same agreement. Sarah negotiates the real estate contract. Jason manages the mortgage process. A change in one can affect the other, but neither professional should casually assume that changing one automatically changes the other. For example, Jason cannot simply announce that the purchase contract closing date has moved. Likewise, Sarah cannot promise Carlos that a contract amendment automatically satisfies the lender's requirements. Coordination is the key. What would you do? Imagine you're Sarah. It's 11 days before closing. Carlos tells you, "We changed lenders yesterday, but don't worry. The new lender promised they'll close on time." What would you do? You wouldn't simply write "great" in a text message and move on. You would communicate with the new lender. Does the lender have the contract? Has the application process begun? Are there appraisal issues? Does the lender anticipate meeting the closing date? Are there disclosure timing concerns? Does escrow have the new lender's information? Does your broker need to know? You aren't underwriting the loan. You're identifying the transaction risk. Broker tip: ask one question before every major change. When a finance buyer wants to make a major transaction change, train yourself to ask, how could this affect the loan and closing? You don't need to know the answer. You need to know enough to ask the question. A price change, seller credit, lender change, loan program change, down payment change, or closing date change may travel through several parts of the transaction. Get the right professionals involved early. Chapter 3 comes together. Emily and Carlos have now learned that the loan estimate isn't necessarily a document that appears once and disappears. Transactions change. Consumers change their minds. Rates lock. Appraisals create problems. Contracts get amended. TRID establishes rules for how creditors handle those changes and when revised estimates may be used. But we're approaching the most important transition in the entire course. Emily and Carlos are getting close to closing. The loan estimate is about to give way to the document consumers see near the end of the mortgage process, the closing disclosure. In Chapter 4, we'll follow Emily and Carlos into closing week and answer the question every agent needs to understand. When does the buyer have to receive the closing disclosure? And what happens if something changes after it arrives? Online discussion 1. Carlos wants to reduce his down payment shortly before closing. Why should Sarah immediately encourage him to discuss the change with Jason? Answer: changing the down payment may affect the loan amount, monthly payment, mortgage insurance, cash to close, qualification requirements, and other financing terms. The lender needs to evaluate those consequences and determine whether revised disclosures or additional underwriting are required. Sarah should monitor how the change affects the real estate transaction without recommending a specific mortgage structure. 2. Emily and Carlos change lenders 10 days before the contractual closing date. What should Sarah do? Sarah should promptly communicate with the new lender and determine whether the lender reasonably anticipates meeting the contractual closing date. She should confirm that the lender has the necessary transaction information and determine whether appraisal, underwriting, disclosure timing, or other issues may affect closing. Escrow and the broker should be informed as appropriate. Sarah should not assume that changing lenders automatically changes the purchase contract's deadlines. Why should a seller credit be discussed with the buyer's lender before Sarah promises how the buyer will use it? Although the buyer and seller can negotiate a credit through the purchase contract, loan program and lender requirements may limit how the credit can be applied. The buyer may not be able to use the entire credit exactly as anticipated. Coordinating with the lender before making promises helps prevent a negotiated contract benefit from becoming a closing day surprise.